When you look at what's really driving fintech in the United States right now, it stems from this hyper competitive atmosphere that exists because there are so many financial institutions in the United States. And there's this kind of looming threat that a lot of the banks that exist right now are likely to either get acquired or likely to lose the ground that they have over the next 5 or 10 years. This threat is very real, and there's some very depressing statistics for bankers out there. But ultimately, what this means is that there are a lot of financial institutions that are fighting for their survival right now. And fintech is a really useful tool for all of them in terms of being able to acquire more customers, growing their deposits, being able to operate more efficiently. And right now, the fintech ecosystem in the US is largely prioritizing how can we help these banks that are struggling or that might be struggling in the future? How can we help them stay solvent, help them continue to grow? And so much of the ecosystem right now is centered around that as the primary goal.
Hey everybody, I'm very pleased today to have my friend and my collaborator and my brains trust in the US, Greg Palmer, who's head of strategy and a host at Finovate. He's got access to a whole range of fintech players in the US and a front seat view of how innovation is taking place in the financial industry in the US and a lot in the the Western Hemisphere. So I'm plugging into Greg. Thanks for doing this session with me, Greg.
Oh, my pleasure, Emmanuel. It's really great for me to be here. I should say right now, I've never worked for a bank. I've never worked for a fintech company, but I've had a front row seat for a very long time as we've been watching a lot of these big picture trends come through. So happy to share my insights, happy to be here with you, and happy to continue the conversations that we had on the Finovate podcast a couple weeks ago.
And you know what? Because you're my brains trust, we should do these conversations regularly. But before we do that, let's just let me ask you on a clean slate, what's on your mind, and what's headline in the fintech ecosystem in the US right now?
Yeah, well, certainly there are quite a few different things happening. I think a lot of people have been talking about the credit crunch, the capital crunch that's going on, and the difficulty some newer stage companies are having when it comes to getting funding. That's not necessarily confined to the US, of course. But I think when you look at what's really driving fintech in the United States right now, it stems from this hyper competitive atmosphere that exists because there are so many financial institutions in the United States. And there's this kind of looming threat that a lot of the banks that exist right now are likely to either get acquired or likely to lose the ground that they have over the next 5 or 10 years. This threat is very real, and there's some very depressing statistics for bankers out there. But ultimately, what this means is that there are a lot of financial institutions that are fighting for their survival right now. And fintech is a really useful tool for all of them in terms of being able to acquire more customers, growing their deposits, being able to operate more efficiently. And right now, the fintech ecosystem in the US is largely prioritizing how can we help these banks that are struggling or that might be struggling in the future? How can we help them stay solvent, help them continue to grow? And so much of the ecosystem right now is centered around that as the primary goal.
Okay, what's interesting about taking a view of the US from far away is that on the one extreme, we get the JP Morgan Chase, which are benefiting from the consolidation. I mean, they're becoming larger every single day. And then on the other extreme, you have a Battlefield. And actually, I follow the stock price of different US banks, the regional banks. And it's so interesting to see that some regional banks have had the stock price go up off the scale, and there are others which are languishing and actually about to die. So what's the one product that is defining the battlefield right now?
Well, I think really right now it's a war for deposits first and foremost. Where you've got a lot of financial institutions that are seeing their customer base getting older and older, and as those customers end up passing on, their assets that they owned are leaving those financial institutions, and they're not coming back as younger generations are moving the money to other places. So at a really high level, this is going to be the thing that ultimately cripples a lot of these financial institutions, is simply losing the access to the deposits that they have. On a smaller level, a lot of customers are doing different things with their money. Instead of having all your money in a checking account, of course, you now have money that exists in Venmo or in other peer-to-peer places, or you're moving it to a third party who provides some wealth management services for you. So American consumers are really splitting their money out across multiple platforms, which means that even if you still think of yourself as a customer of a given bank, the percentage of money that you have deposited with that bank is shrinking. And it still might be kind of your top of mind bank. Oh yeah, I'm a customer of, JP Morgan, or I'm a customer of Bank of America, but my money isn't all there any longer. And that's, I think, the real challenge that a lot of these banks have to solve. You pointed out something really interesting. There are kind of multiple tiers. There's these mega banks that exist at the top of the pile. They're doing okay. They don't really need to be as threatened by this. But a lot of those smaller financial institutions, the community-based credit unions or community banks, they're the ones who are really acutely in danger here. And so it's fascinating to see, as those groups really compete with each other, as they look at how they can grab those deposits back. Fintech is obviously one of the first places that they're looking, because there's so much of value that is coming from the ecosystem.
You're talking about payment wallets. Did FedNow accentuate this attrition, this shift in where the deposits are?
FedNow hasn't really had much of an impact yet. I think most of the times I've been hearing about it over the conference, and this is, an old joke, but it's been called Fed later because it's been taking so long for it to actually roll out. But FedNow certainly has a potential to make a difference here. It's hard to see how FedNow is going to give any individual entity a competitive advantage, though. And I think that's really the piece that, it's useful when it comes to potentially keeping more money in banks overall, as opposed to going into outside providers like Venmo. But it's hard to see how, a savings and loan company that operates in a small geography is going to necessarily benefit relative to their competitors who are coming in and moving into that space. I still am a big fan. I think it's going to be a really excellent thing for the entire ecosystem. And again, the end user is the one who's really going to benefit. Certainly the general population will feel the benefits of FedNow, but it is difficult to see exactly how a bank wins or loses on the back of what happens there.
Okay, because what you're talking about is the attrition of deposits to digital wallets. Many of them are the fintech players. And you're saying that because in other markets that we cover, this attrition to digital wallets was incremental, was slow, was so a tiny proportion of the market. I mean, the total asset size in any one market: Hong Kong, Korea, Singapore. The digital banks, for example, about 1%. Attrition against the 99% that the banks have. But what you're saying is that in the U.S., for the regional and the community banks, that attrition is real.
The attrition is real. And again, I think primarily it's driven by the fact that customers are aging out. And as that older generation of customers end up passing on, their assets move to their children, and their children are shifting into different, either whether it's a neobank or a bank that's closer to themselves. So the primary driver of the deposit war probably comes from that demographic shift as much as anything else. But certainly, Venmo is taking its piece of it. And so if you look at it, it's just so easy to keep your money in Venmo. If you get paid in Venmo, and then you want to pay somebody else in Venmo, that's money that used to come into a checking account. It was sitting in a checking account until it moves out. Now it's just kind of sitting off to the side. And that makes it really difficult for banks who offer checking accounts to get a lot of value out of their customers who have them. So if I can give you a savings account, great, you're probably more likely to keep more money in there. If I can get you an investment account that you're going to be building longer term wealth, of course, that money is likely to be more steady. But on a day in, day out basis, where the paychecks are actually going, less of it is touching the actual financial institution.
Greg, I call it the digitization of the deposit account. And that's already happened in many different parts of the world. And in China, for example, you have the Alipay and the WeChat Pay, which have become larger depository institutions, and in fact, even lending back into the interbank market because they've got a huge deposit base, and they lend it at a much higher interest rates because the small community banks in China are desperate for liquidity, and they'll pay almost any rate for that, right? So that makes Venmo a potential depository institution that is a player, just like any other bank. But
Well,
is it
this is
just
a really
Venmo?
fascinating thing too, because I think you have to start asking yourself like really fundamental questions. What is a bank? At what point do we call something a bank any longer? Because there are a lot of different services or companies that offer specific financial products or specific services, but we don't necessarily think of them as banks. At what point do we call Venmo a bank? At what point do we think of Apple Pay as a bank? People have money in Apple Pay. People have money in Samsung Pay. They wouldn't necessarily think of them as a bank. You can get a credit card, sure, but that credit card comes with Goldman Sachs on the back end. Goldman Sachs, you're like, oh yeah, that's the bank. But over the next 5 years, you're going to really see a lot of just chipping away at this central idea of what even it means to be a
Right.
bank. And that's going to be fascinating to watch as well.
Yeah, I mean, I've got so many questions for you that I just want to go point by point by point. Okay, so Apple Pay, where's that now? Now that their relationship with Goldman Sachs is unraveling.
Well, I mean, this nobody knows at the moment, and I think obviously the question comes down to who's it profitable for? Is Goldman Sachs getting enough out of that relationship to want to continue it? Is Apple getting enough out of offering this service to its customers to want to continue to offer it with a different partner bank? These are discussions that go on way above the pieces that I can see. But ultimately, it always comes back to this really simple side of it, which is who's actually winning here. And if you look at Goldman Sachs and Apple potentially fracturing that relationship, a lot of people were initially very surprised that Goldman was entering into a relationship with Apple in the first place. People were calling it a publicity stunt or saying this is just Goldman trying something out to prove that they're engaged with technology. I don't know that a lot of people expected it to be extremely fruitful on either side. Certainly, Apple, I would say, was more the driving force because they saw the technological ability that they wanted to play with the phone. They wanted to make sure that they were able to offer, if you have your iPhone, you can tap to pay, you can put your credit cards in here and all these fun pieces. But the question is, and it's a fundamental question, anytime a tech company is working with a financial institution, both sides have to win or else the partnership is going to unravel. And so what you're seeing right now is maybe evidence that potentially both sides aren't winning. And so the fundamental dynamic there needs to be rethought so that both people are feeling like, yes, we're both getting something good out of this.
What other names comes out in your mind in terms of digital wallets, potential players? You've mentioned Venmo. We've now just touched on Apple Pay. What other names are out there in the US?
Samsung Pay is probably the other biggest one. Outside of that, I think those are probably the big three. And again, they come from this place. Venmo is the outlier because Venmo created a new company and was able to go and get that name brand recognition. So now, people will say, they'll use Venmo as a verb. I'll Venmo you. And it's just become commonplace. And so, I was out, my kids do youth sports. After one of the tournaments, we had a big team dinner. Instead of splitting the bill, the parents were all on their phones. Okay, well, I'll just Venmo each other. Somebody put a credit card down and everybody else chipped in $20 by Venmo. And there was never any doubt about how we were going to do it. Venmo is ubiquitous in that sense. Now, that's a really difficult thing to accomplish for a fintech company to get to that level of market saturation and general awareness. Apple obviously had a significant advantage because everybody knew who Apple was. Everybody knew what the iPhone was. Same thing with Samsung. You understand who this brand is. And now they offer it almost as a feature to an existing product as opposed to a new product on its own. So, you can't necessarily compare the two, but Venmo is an outlier from what I've seen in terms of financial technology, in terms of being able to actually get that direct to consumer play, get that awareness going. And so they've done a very impressive job.
Okay, Greg, I know that we are hard pressed for time, and therefore our conversation will be rather short today. But I'm going to, keep tapping on you regularly. But the
Yeah.
conversation that I wanted to take on with you today was supposed to be on AI and fintech, right? Top of mind, what do I need to know about who's doing what in AI and fintech that we need to pay attention to?
Yeah, well, I mean, I think at this point, AI is touching almost every fintech solution, or at least that's how it feels. The companies that come across our stage, who came across our stage in 2023, I think about 55 or 60% of them were incorporating AI or machine learning in some way. Now, this is where you can get into a theoretical debate. When is it AI again? When is machine learning kind of cross that threshold and become artificial intelligence? And a lot of companies have recognized that this is one of those buzzwords. We need to make sure we're talking about AI. One of the really big difficulties right now in the ecosystem, as far as I can see, is sort of separating out these companies who are really driving AI forward and getting into it from that hyper technical standpoint and saying, this truly is something that is a new type of solution. And those companies who are kind of putting small tweaks on an existing product and saying, oh, hey, now it has AI, now it's machine learning. And a true technologist would say, I don't think so. I don't think that really exists. This is a real challenge for everybody because everybody has to try and become an expert on this overnight. It's especially a challenge for bankers who are not fundamentally grounded in the technological side of things. So you put yourself in a position of a banker where all of a sudden you have 50 companies coming to you and saying, hey, we all do AI. And you have to try and say which one is the best one. That's almost an impossible situation. So what this means is that really strong technical solutions are struggling to get attention because there's so much market saturation and so much noise, people talking about it. Even if you're really good at it, you won't necessarily get the recognition that you deserve. At the same time, a lot of very successful companies have marketing departments that are really massive and are able to kind of jump into the pool and make a lot of noise and get a lot of attention. So the biggest challenge, I think, right now is, first off, separating who's really delivering AI and who isn't. Now, that aside, there are a number of kind of more practical ways to think about it. I think, when it comes to fraud and anti-fraud solutions, AI has a massive role to play. The depressing news is that AI also has a massive role to play in creating fraud. And so there's this AI arms race going on right now where who's going to get ahead? Will the fraudsters get ahead, or will the security officers get ahead? And, they're just going to keep going up and up and up. But I think this is one of those really practical applications where artificial intelligence makes a lot of sense. And hopefully we can stay ahead of the people who can use it to create your voice and call into your bank and, hopefully not, but potentially in the future, be able to voice authenticate into your account based on an AI version of your voice. Pretty
Right. Now,
terrifying. The good news is there's AI on the other side as well, combating it. So eventually
right,
it's just going to be computers fighting against each other. And all of us just kind
right.
of sitting and watching and being like, I hope the good guy wins.
Yeah. Top of mind names that you like, that you've seen are doing interesting things.
So I try not to give too many companies a shout out because so many of them come across on my stage and I have to be, friendly with all of them. One company though, that I have seen a couple of times who won Best of Show at Finovate Spring last year is a company called Savvy AI. They do a very good job of kind of balancing that tech side of it. So they're a good one to keep an eye on. Outside of that, there's nobody that I would kind of specifically make a plug for, but a lot of companies are doing very impressive things. And I expect we'll see some more this year, Best of Show winners who are operating specifically in that AI space.
In the area of payments, you have different affiliations coming around. Some of them are trying to take payments into the cloud. Some of them are trying to integrate with existing platforms, and so on. So, what's happening in the payment space, and of all the payment vendors, the payment fintechs that you talk to, who stands to be a winner in the US ecosystem, which is essentially very different from the rest of the world, because the US has got such an endemic, prevalent payment infrastructure already, and any fintech that comes on stream is trying to chip away and revolutionize the system, but it's a hard slog up the hill, right? So,
Yeah.
so in that sort of an environment, who's chugging along well? Because I also noticed, by the way, just before we started this conversation, that PayPal has been slammed by the investors. So, maybe because the new CEO is like trying to manage expectations and put a lowdown on their earnings potential for the rest of the year. So,
Yeah.
so what's happening on that front?
So yeah, there are kind of two fundamental factors at play, two truths that exist in the payments ecosystem. And the first one is that the current payment providers are taking arguably more than they need to take out of each transaction, right? They're leaving a gap where, let's say, you're giving this much, and you could theoretically get away with giving half of that when in terms of how much money you're actually taking as part of the payment process. this creates an opportunity for somebody else to come in and undercut your pricing and say, I can actually move that money faster, or I can move it more cheaply so that the end user doesn't have to pay for it as much. To some extent, this is already happening, right? If you look at credit card rewards, this basically what this is. That's saying, that's a credit card company saying, we recognize that we're taking too much. We're going to give you a little bit of that back in the form of credit card rewards, whether it's airline miles or cash back or whatever the case may be. Out of our 3% that we're taking, we'll give you 0.5%. And this is kind of what the credit card industry has decided. And they fight with each other about it, but more or less the big credit card companies offer roughly similar rewards. And if you look at NerdWallet and they compare them, we've kind of agreed this is where the standard is. Now, there are any number of new technologies that can come in and say, we can actually move this money. Instead of charging you 3%, we can charge you 1%. And you think, well, that should be a no-brainer, right? Everybody should want to do that, because if you can just take 2% of your expenses off of every single payment transaction that you have, obviously that adds up over time. On the flip side, you have this massive incumbent advantage that exists because there's companies who've been in the space for a very long time, who have this name brand recognition, who've been saturating the airwaves with commercials for the past 30 or 40 years, and have built up this idea that you think Visa, you think MasterCard when you think, how am I going to pay for something? And they've been very successful from a marketing standpoint of making sure that every customer thinks of them in that way. This incumbent advantage is huge. And there are a lot of really strong fintech solutions out there that have struggled to get the notoriety to kind of break through. And what we've seen in the United States, it's very difficult to take any fintech directly to a consumer. It almost always has to come through a banking partner or some sort of larger incumbent partnership. And what that does is it really limits the amount of options that consumers have, or at least the amount of options that consumers feel like they have. And ultimately what that means is that you still have the situation where you kind of in the back of your mind, you think, we really should be able to do this for cheaper. Somebody should be able to come in and do this for less, but it still hasn't quite happened yet because that incumbent advantage is so strong, because people are so used to thinking of certain payment processors as, this is their only option. We're chipping away, as you said. That's, I think, a great way to think about it. There's progress being made, and every little bit of progress kind of puts more pressure on these large incumbents to reduce the amount that they actually take, to offer more rewards. They have to be competitive at the end of the day. And so that pressure, I think, is ultimately a very good thing for consumers, for end users. But so far, we haven't seen a massive shift in the payments ecosystem from a retail standpoint. And maybe we're starting to see one from a B2B standpoint. We're now starting to figure out there are some other ways to do it there. But even that, it's still not as far along as you might think.
Right. One other area, actually, there are a couple of other questions I wanted to ask you on payments, but just for the sake of time, right? Now, in digital assets, there's a lot happening. Many banks around the world are preparing platforms to become digital asset custodians, digital asset platforms for transactions, and so on. What's the feel of digital assets as a business in the US right now?
So most of what I hear from the bankers who come to Finovate essentially amounts to cryptocurrency is a scam. Nobody's going to get rich off of it, but we probably need to do something in that space. That seems to be the sentiment, because people recognize that there are consumers who are going to want it. And anytime there's something that consumers are asking for, somebody needs to step up and provide that service. So either it's going to be someone like Coinbase who's going to be able to do this. And kind of coming back to the earlier piece, Coinbase certainly leaves room in terms of their margins and their pricing. There are a lot of ways that you could, offer the same basic product, same basic service for less, but it's not something that I think a lot of bankers themselves on a personal level are incredibly excited by. So some of them, I think, if you look at a smaller financial institution who's going to get active, you might think, well, they might be looking at this as their best chance to kind of make themselves relevant, to help themselves stay relevant in the future. This might be the bet that they're making. Some of the larger companies that are in the space, you almost think, well, do you really want to be here? Or are you doing it because you feel this pressure, because you think if you don't, somebody else will? And so I'm not sure where I net out on it. I think obviously some high profile things that happened in 2023 really hurt the perception of the cryptocurrency industry. And obviously consumers sometimes struggle to make distinctions between, something like Dogecoin and a USD stable coin. They think, oh, it's a cryptocurrency. And you think, well, there's actually a really big difference between Dogecoin and a stable coin, but consumers, again, don't always think of it that way. And so this is where it's going to be fascinating, because I think ultimately what's going to really lead this charge is consumers themselves. And that's so rare. So often financial institutions are telling consumers, here's what you want. You can choose from these three things. Those are your options. Done. That's all we've got. But in this space in particular, it's going to be the other way around, where consumers are going to be actually the ones telling their financial institutions, hey, this is what I want. And if you can't give it to me, I'm going to go to somebody else who can. And I love that, by the way. I love it when consumers have a chance to kind of take that level of control. So I'm all for it. Again, I've never worked for a bank, so I don't see that side of it necessarily. But I like to see consumers being a little bit more demanding and advocating for themselves and saying, here's what I want. Please give it to me.
Greg, you're my brain's trust. This interview or this conversation we just had, that's for the members of our future bank working group. And if they have questions, I'll give your contact and maybe invite you into the group so that if they have any questions, they can ask you. And then later we will promote this to our wider audience for them to hear as well. But I look forward to our next conversation, which will be held after Finovate Spring, right? So Finovate Spring is where all of the fintechs in the US come together at your show. So I'm going to plug on you on to get a sense of what happened at Finovate Spring and the trends that you see.
Yeah, no, absolutely. Happy to do it. We'll touch base again in late May or early June. And then, of course, we have Finovate Fall coming up in September. And, I'm sure, as everybody's predicting, the next 6 months are going to be really interesting, because we'll see what happens when it comes to venture capital lending. We'll see what happens with how consumers are responding to people talking about like a crypto spring. We'll see what happens with Fed now as it kind of becomes more fully fleshed out. So there's a lot to keep an eye on, and no shortage of topics for us to continue to chat about, I'm sure.
Wow, even in that one paragraph, you've identified all the issues. So thanks very much, Greg, and I got to let you go.
No, my pleasure. Yeah, my absolute pleasure. Thanks for having me.